The volatility we're seeing is well within the bounds of what we modeled in our stress test. There's other folks, I say, the biggest lever, just generally speaking, if you want general advice, the longer you work, the better off you are, right, in retirement.
True.
And it may be better for your health.
Yeah.
Well, yeah.
Mental health.
For some people,
sure. Yeah. We have some clients where you probably need to get back to work because you're watching TV too much.
Life's Third Act is a podcast dedicated to helping you get the most out of your retirement. Sponsored by Tucker Allen, Attorney-CPA Joe Cordell features guests each week to discuss prominent topics for those over 55. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of Life's Third Act. We think that you will find this discussion today, Jill, I think we can say very timely. We try to bring you things that reflect probably what you're going to be confronting in the near future or the not too distant future. And we all know the economy is going through changes. We don't know exactly where it's going, but it's probably not going to continue the same upward slope. So we expect that there may be some challenges ahead, a little bit of a recession. We don't know how much. And we thought, well, what the best thing we can do for our clients, since their budgets are so important to them in retirement, a lot of you are living on pensions and your savings through 401ks and IRAs and whatnot. So we wanted to bring somebody in, some people who can talk to you from a authoritative perspective about kind of what lies ahead, and also to talk a little bit about the whole subject of estate planning or financial planning as it pertains to older people. So toward that end, as we infallibly do, I have to actually give credit to Jill. She's the one who manages to find marvelous guests more often than I do. So, Jill, why don't you introduce our guest?
I would love to. We have Don Hutchinson. He's the Managing Director of Institutional Advisory Services at Goelzer Investment Management of Indianapolis. And here with him is Brett Stehl, and he's the St. Louis-based institutional consultant. And you were just given that role. Congratulations.
Thank you. Thank you very much. And thanks for having us. We appreciate it.
Our pleasure. So explain this. Goelzer, of course, has been around a long time, but until just now, you've not had an office in St. Louis, till just recently.
Yeah, correct. We just actually celebrated this past March our 53rd year in business.
Wow.
Congratulations.
Thank you. Back in 1969. We've always had clients really throughout the U.S., 35 states, as well as Europe, but have always sort of centrally located our offices in Indianapolis. This is a new endeavor for us, is to open up an office, finding some really good people out there in the Midwest, and continue to sort of expand geographically. And this is our first expansion, so we're very excited to have Brett on board.
And you expanded, to Wisconsin as well?
We're right now, we are strictly offices in Indianapolis, and then Brett is our first employee outside of the state of Indiana.
Okay.
And you chose St. Louis. Tell me why you chose St. Louis.
Great community, deep heritage. A lot of history here, but it's a community very similar to Indianapolis. It's got good Midwest roots. I think relationships matter. And I think the type of client matters. We tend to have clients that are more conservative in their stance financially. That sort of syncs up with our philosophy, and so we tend to do better work that way. So we're really excited about St. Louis. And it's 3.5 hours away, so it's
not bad.
It's very Cordell. We opened one of our earlier offices was in Indianapolis, so there are a lot of similarities. Also a sports town.
Yes. Yeah. And you get your sports sort of complement ours a little bit. We have basketball, right? You have hockey, that kind of thing. So it works out really well that way.
Yeah, we don't butt heads as much. No. But you have football, which we tried.
Yes.
But
I know.
Yeah, that's a whole nother show.
So I'm curious. You have a lot of clients though who are over 60. And that's one thing that attracted us to your firm in terms of planning and financial advice, was to get your thoughts about first of all, what do you expect over the next year to 5 years maybe? And how are you dealing with this with your clients who are over 60?
Sure. Absolutely. That's a great question. So to that point, more than half of our client base are private clients, and the majority of them are in retirement years. So they are really focused on how their financial assets are performing and making sure that they can have secure income throughout retirement. And obviously, the bouts of we're seeing right now with inflation cause some problems there and some concern. And likewise, we think we're really at an inflection point here with the economy, but more so with longer-term policy, if you will. We just went through a period of time where monetary policy was really easy. And actually was very interesting. It benefited folks that take a lot of risk, investors, but actually hurt savers, if you will. It was sort of financial repression for folks that are counting on bank accounts and CDs and bonds and what have you. So it was a difficult time for them. We think that is finally changing a little bit. We're also seeing it in the type of stocks that are working now. We're big folks in terms of quality stocks as well as value-oriented stocks and dividend-oriented stocks. Those are really benefiting now, where obviously it was all growth and speculative stocks the last 12, 13 years. So from that perspective, the other side of this, when we get through this transition period, I think it's going to be a lot better for our clients, if you will, that are in retirement today.
I'm glad to hear you say that about you think there's an inflection point, because that's been kind of my thought too. And the fact that we did this historically unprecedented thing coming out really to 2008, where suddenly rates go all the way down. And so rates, as you all know better than I do about calculating the values and how when you have, interest rates below 1%, that it inflates the value of every asset out there, including everything on the stock market. So it didn't make sense to me that if you suddenly go from, say, a 1% rate, which actually was below that, to, say, 3%, not to mention if it's 4 or 5, that doesn't have a dramatic impact on the value of all the stocks, because all their values reflect this artificial reality, which couldn't endure. And so now, as you said, and I haven't heard a lot of people say that, so I'm glad to hear you say that, is that, there is I would call it a coming to reckoning, where we got to entertain this stimulation and artificial prosperity for a long time, and it worked. But there does appear to be an adjustment that's probably going to be fairly long term. Do you think?
Yeah, it's interesting. I ran into a younger gentleman in the elevator at our office buildings probably 2 months ago or so, and I felt really bad. He looked sick to me, right? I mean, physically did not look well, and I asked him. I said, "You doing okay?" And he goes, "I just got done going and seeing my broker, and my portfolio is down 65%." And I thought to myself,
lots of growth stuff.
What were you in, right? And he was in all the speculative stuff. So to your point, and it takes every generation's got to learn that. We learned that back in the 2000 dot-com bubble, if you will, and we've been telling our clients for the last several years, these valuations don't make sense. These companies aren't earning money. They're not quality, they have quality balance sheets. This will come to an end, and now you're seeing it. Unfortunately, the good news for us is our retirees, they're focused in, we have a rising dividend strategy. They're focused on dividends, value strategy, those kinds of things that are holding up much, much better today, I think, to your point, than the growth stocks, if you will, especially the speculative stocks.
And they weren't as juiced by the free money.
No.
I mean, the tech companies where they weren't making anything. And technically, I guess you value it at infinity if you imagine what profit, if it ever comes, is going to be. So your investors then you as a company tend to be more conservative. So you didn't put a lot of people into the tech sector. And
no, we have so Goelzer has sort of three, what I would say, sleeves, if you will, or divisions. We have our private client group, and then we have our institutional advisory group.
What is that? Explain that.
Yeah, so what that is we're really serving the needs of foundations, endowments, not-for-profits, private schools, what have you, really in what we call sort of the small to mid-size part of that market. So, $5 million or so is a reference point on the low end, up to typically somewhere in the ballpark of $200 million or so. That group is underserved, in our opinion, relative to the large billion-dollar-plus institutions. And we think it really fits well with our service model. We tend to have a very intense service model at Goelzer, which is we're spending a lot of time with our clients. Those organizations tend not to have what I would call internal resources for investments, or in a lot of cases, maybe one financial person within that group, because they're focused on their programming, right, and all the good things they're doing in the community, right? So from that perspective, we really act as almost an extension of their office in a lot of the things we do. So it's not just the investments, right? That's, we do that very well, but a lot of other elements to that. And, we can talk about that a little bit, but that's the difference. The nice thing is there's a lot of things that rhyme between our private client group and that small to mid-sized institutional group. Spending policies matter for everybody, right? Whether it's an individual or an institution. And so, and a lot of the planning we do, right? We're very plan first, product second, if you will, at Goelzer. So we are a registered investment advisor and a fiduciary to our clients, which means we do not get paid anything, no commissions or anything in terms of product placement. But strategies are important. And
so you're a fiduciary.
Yeah, absolutely.
I'm glad to hear that.
Yeah.
So you don't base your revenue on the products that you.
Yep. No, we used to be a duly registered firm way back when. We switched to fee-based only, registered investment advisor, fiduciary, essentially standard. Oh gosh, it's been probably 10 years now or so.
So Brett, what is your background?
My background is working with the institutional clients, like he had mentioned. So I've worked with a lot of smaller nonprofits, endowments, and you do see a lot of overlap there on the client side to the institutional side. A lot of our private clients are involved with these different charities that are very passionate about. They might work as a volunteer. They might work, be a member of the board. So it's very interesting working with these individuals and just seeing how passionate they are, and then also helping them with their cash flows, and then ideally seeing that come to fruition and seeing the impact that we can.
Are you a St. Louis native?
I am a St. Louis native, yes.
Okay.
Yeah.
Have to ask you the St. Louis question. Where'd you go to high school?
I'm more St. Louis native from the Illinois side. So
Metro East. Okay.
Yes.
Okay.
So St. Louis Metro.
St. Louis Metro. I guess I should clarify that. And then I went to Southern Illinois University down in Carbondale.
I saw that on your bio. I'm Southern Illinois University at Edwardsville.
Okay. Some similarities there. That's actually where I got kind of my interest in the nonprofit foundation side. I did an internship with our foundation at SIU when I was there, and my first job out of school was really kind of in that same lines of work as well. So that was my first entry into that type of client.
And what do you hope to bring to the table with this new appointment?
Yeah, I think really, I had met with everybody at Goelzer multiple times before I started at Goelzer, so it was really a fit to make sure that it was a fit for me from a firm perspective, and then that they believed in me as well. And I think that the culture, the values, everything's very similar. In Indianapolis, they're very well respected, very involved in the community, assist with multiple different philanthropic charities, and I really want to kind of bring that to St. Louis as well. And as Don had mentioned, helping some of these smaller to mid-size that might not have somebody on staff that can help with these investment decisions.
Right. Providing that expertise.
Yeah, providing the expertise and really helping with, what we see best practices from a donor development standpoint, and allowing them to really get out in the field and do what they do best.
So does institutional include like churches as well?
Yes.
Absolutely. Religious organizations, yeah. So we have several clients in that ilk. In fact, a couple that are what I would call agnostic, but they support all religious affiliations in terms of helping them develop resources and programs so they can have better reach in the community, if you will. So
Yeah. So when you approach then developing a client base here, putting aside the institutions that you'll focus on those connections as well, but how do you go about developing a client base here like the firm has in Indianapolis?
Yeah, I think just items like this. So getting out in the community, getting that presence out there. So being as involved as we can, being supportive of a lot of the local charities and nonprofits, and just having that involvement. I think that's the main thing. And that's one of the main reasons why institutional as well. There's both to provide that service, but just from a firm perspective, really that philanthropic DNA that's built in there into Goelzer. So I think being able to relay that here into St. Louis will allow us to get our presence.
But y'all don't do a lot of marketing.
No, we're doing more of it, right? But historically we sort of focused our resources on working with clients and working on the investments and what have you, and less on the marketing. I think you're going to see more and more of that out of us. We hired our first director of partnerships, if you will, within the firm a couple years ago. That's going to be a big play, I think, into the St. Louis market. And we've hired some outside advisors to help us with things like this, if you will. At the end of the day, it's a people business, even though institutional is just as much a people business, and Brett said it, our private clients sit on those committees and those boards and what have you, and we care a lot. I meant to bring, I left it in my other car, but I meant to bring our community engagement report. I'll send it to you all, but it is what I want to see. My vision is in 5 years, that community engagement report has as many Indianapolis or Indiana-oriented things that we're involved in, as well as St. Louis, Missouri, and Southern Illinois. So that's our goal, is to bring that. It is in our DNA. I've worked with multiple firms, and I can tell you, our firm is very focused on clients first and supporting the community, not just on the me thing, if you will. And I've seen that with other firms.
So describe the process, though, focusing on your private or your individual practice. What is the process when somebody contacts you, say that they have a couple $1 million maybe accumulated in 401k or whatever it might be? They're over 60. How does the relationship unfold at that point? What happens at the first meeting?
A lot of listening, a lot of questions. We want to understand what the goals of the client are, if you will, what they're looking to do. They're 60. They're getting close to that decision to retire. So we want to understand essentially, what does that look like? What does your lifestyle need to be in retirement, if you will? And so we collect a lot of information because we start plan first. It's all about planning at Goelzer, whether it's an individual client, pre-retiree, or an institution. And then what we do is we take that information. We typically give them a risk, essentially, questionnaire right out of the box.
Do they complete that before they come in?
No, they typically complete that at the second appointment, if you will. The first appointment is just a lot of discovery and what have you. We do a lot of that if they're technology inclined, which most folks that are in that baby boomer generation are. It's the other generation that sometimes is a little tougher, but we'll actually send that to them, and they do that online. It takes about 10 minutes. Really helps inform us of what their risk tolerance is, and then we come and we say, okay, you have this much saved, and we look at the different buckets it's saved in, and this is what you aim to live off of, if you will. And we have a lot of modeling software that we work with, right, to then give them some ideas of what does that time horizon look like, and what's the probability of success, right? And we do that through some Monte Carlo simulations. We have some other stress tests we use, cash flow planning, and there's a lot of tax implications to it. I don't want to get wonky here with all the inputs, but the inputs are important. And right now, one of the big inputs is looking at inflation, right? Mm-hmm. Might be a little different here for the front end of the next, maybe 10 years or so. And then every year, Goelzer comes out with capital market assumptions, which are what we think the returns are going to look like over the next 10 years. And those inputs are important because the next 10 years, in our opinion, is going to be a lot different than the last 10. And we think the biggest risk in retirement is those right before and right after you retire. We really want to try to avoid those big drawdowns, right? You don't want to retire right into a bear market, and we want to be cognizant of that. So.
Yeah, and that's one thing that I don't think is made clear enough to people whose timeline is shorter. That while it's true that, for example, if you were to do a monthly investing plan in which you ride it up and down, that works out in the long run, the average. But for people who don't have a horizon that long, then as you point out, the math is hard to recover if they start out in a bear market. And even if things go up later, the math it's difficult to recover. And I think that that some people are going to be more inclined to reach for security and something like annuities and whatnot, and there are strong opinions on that topic. Some advisors hate them, some like them. I like the fact that you're not in a position where you're selling a product. So it's one advantage, and the reason I'm a huge fan of people who approach financial planning as you do, is that your clients want to count on the best advice, and when the incentives are wrong, when the incentives are in this direction and the client's interests are in this direction, it's not a positive thing. You want to be incentivized in the same direction. And so I worry about whether the discussion of annuities that becomes so popular with people over 60 is really presenting a full picture. What are your thoughts on it?
Yeah, that's a great question. I think from a product perspective, I think people, especially right now, the uncertainty, they're looking for a silver bullet in a product, and there isn't one, if you will. There just isn't. The solution is in the plan, right? So our advice is let's revisit the plan. Right? We had a client the other day said, well, this inflation, maybe Social Security will be insolvent in the near future, right? Okay, let's go back to your plan, and let's just take Social Security right out of it. What's the probability of success? 86%. For us, that's good, right? You're in a good place, right?
Yeah.
So we focus there, right? Versus looking at the annuities or those kinds of things. If it makes sense, in particular, from an estate plan perspective, some life insurance products make a ton of sense, right? We'll suggest that. But like you said, we're not incented to push that. So it's all those products that come into play, if you will, are all based on what does the plan say.
But when I think of the variety of things that can go wrong over the next 10 or 15 years, the top of the list wouldn't be getting rid of Social Security. Right. Yeah. I mean, I worry that now there's this indifference about government expenditures because the assumption is you just print more money. And so I think maybe inflation could be a problem, that your Social Security may not be worth much. But that wouldn't be the top of my concern.
We sometimes have to, appease clients.
Yeah, you're right. Client's boss.
Right, that's right.
I hear you. So whenever you're putting together a plan, then is it common for it to include clients working, or do you look for passive investments versus investments that are kind of actively managed? Yeah.
I think in terms of the client continuing to work, you mean at some point? Yeah. The great thing about our software, if you will, is it allows us to identify some levers, if you will, and we can turn them on or off. And one of the levers we could turn on is, let's say you continue to work part-time for 5 more years, right? What does that do to the terminal value in the plan over the your time horizon, your retirement time horizon, versus what if we turn that off? We just had a client the other day said, I might work another 2 years, 3 years, 4 years, or I might just want to call it quits, right? Well, let's look at all 4 of those scenarios, right? And what does that do? So we can do that in that modeling. In terms of active and passive, we're very middle of the road with that. Here's what I would tell you, just in terms of shortness. We think active management really pays off in markets like this, right?
Yeah.
And so you typically weak markets, active management's better. In upward sloping markets where everything's doing well, it's tough to keep up with passive investments.
What would you say to someone that's thinking, that had planned on retiring this year, and with inflation skyrocketing, I mean, would you say, let's hold off a little bit? I mean, asking both of you guys.
Yeah, I think the one thing that you had mentioned, and he talked about with the inflection point, is the Fed is starting to make moves right now. And so we just saw an hour ago that they raised interest rates by 0.75. That is good for the saver in the long run. And so the portion of your money that's in those bonds, if you delay your retirement, then it's going to be putting off more income. And so that portion of your portfolio that was just a year ago not yielding much at all is now going to give you at least some. So that's going to be able to offset your expenses more than what we're seeing right now. Okay. And so you won't have to take as much risk in the equity markets.
Yeah, I would tell you it's all based on your situation. So go run the plan again, right? Update the plan and see if
Right.
you can do that. That really is critical. There's some folks that have amassed enough resources that even with a tough economy, our modeling takes into account some pretty heavy stress tests. They're going to be just fine. So what we're doing with clients is that are right there. I have one in particular client that's been sort of planning the last 3 or 4 years. We just updated their plan and it looks good. They're going to be okay. The volatility we're seeing is well within the bounds of what we modeled in our stress tests. There's other folks, I say, the biggest lever, just generally speaking, if you want general advice, the longer you work, the better you're off you are, right, in retirement.
True.
It's just,
And it may be better for your health.
Yeah.
Well,
yeah, mental health.
For some
for
people,
sure.
yeah.
We have some clients where you probably need to get back to work because you're watching TV too much.
You slow down, you come to a stop, and it's often not good. So as you consider the range of options, a number of assets, like particularly if you do there's the Treasury bill that has the COLA, tax or inflation adjusted tips, I think they're called. What are your thoughts about that class of investments?
Yeah, so it's really interesting. We were actually just talking about this a little bit. So the biggest question I've been getting lately is, what are these I bonds? Nobody's talked about I bonds in decades, right? Because inflation hasn't been an issue, right? And they're really interesting because of the semi-annual adjustment to inflation, right? So now there's a lot in the press. The I bonds are set to pay, I think, 9.6% or something to that effect, right? Coming up, that's great, right? Well, you're limited to $10,000 investment in an I bond, so that's not going to. That's nice, but no, it's not going to move the needle too much, right?
No.
So a lot of people look at TIPS, Treasury inflation protected securities, and we were just talking about it. Some of these investments that seem really good, there's more than one source of risk and return in the investment. In TIPS, if you buy a 10-year bond, right, or a 10-year TIP, you're doing well in terms of it adjusts, right, for inflation. That part's doing great. That one source of return is doing just fine. The second source of return is you have interest rate risk in a 10-year bond. And as interest rates have been moving higher, you're getting hit. That bond is getting hit in value because of interest rates. So a 10-year TIP year to date's down 9%.
So what's being adjusted? That's an important point you're making. I hope people catch this. So whenever you hear about an inflation-adjusted Treasury bill, you think, it's government-insured, which is true. It's not going to, it'll be paid. But the point you made is the adjustment is not to the rate of interest, it's to the value of the bond.
Right.
That's an important point. Yep. And most people buy it for the interest rate for the income to be adjusted.
Right.
And you're only pointing out that it assures that there will be an adjustment of the value, the face value when you get it.
That's correct. And you still have interest rate risk in that bond, just like you do on any 10-year government bond. So that's where you get hit there. I think 5-year TIPS are a little bit better, right? So you got to just be aware of that. That's why I say this because I think it's important. You talked about active management, but I think passive management in some ways has made some people sort of sloppy or lazy. They don't know. I would say, what you eat, you got to know what you eat, right? What are the ingredients in which you eat? Same with all these financial products that, sort of get pushed into the mainstream, and seniors in general get pushed a lot of product, right? You walk into the banking center and, they're trying to sell you something. Really important to understand what is that ingredient. I do think that is the value of having an advisor that's very thoughtful and really understands what are the ingredients in that product, if you will. Our industry's got a lot of professional shoppers out there now, and they really don't understand, what is really driving the returns and the value of that security.
Let me say a couple things about the difference between active and passive investment, but then toss it back to you guys to say a little more, because the average person, when they're hearing these phrases, they're not really sure what it is, and at one time, I guess there wasn't passive. That came around the 70s or so when people developed the idea of indexes where you essentially buy the S&P or you buy the Dow. And it's passive, meaning that all you do is buy something that reflects the total value of all those stocks. And it doesn't require any day-to-day management. And so there's all sorts of indexes now to where you can kind of put your money on autopilot. And the theory is, and leave it there, and you don't have anybody reaching in on a particular day and saying, I think we should sell DuPont, and I think we should buy Bayer. or those decisions, they're not made. So that's active management is where you have somebody really looking at each company and deciding, let's buy this company, let's sell that company. So you have people in your organization that are capable of doing active management, which a lot of organizations don't even have people who can do that, because it does mean you hire analysts and you have people on the payroll. Whereas if you're just doing index funding, you open up a shop and you buy an index and for your clients. And, in fairness, in defense of that, some indexes have done as well as, or during some periods of times, they've done better than active management. So I don't want to suggest active management's always better, but like you said, there are times when active management pays more than other times.
Yeah, and for your clients, or for your audience, in particular, passive bond indexes we do not think are appropriate, right? If you will, and so you get a lot of concentration in those indexes. You get sometimes, the larger the issue, the more you own in those indexes. You get some junk in those indexes that aren't quality. So we think actively managed bond portfolios or a really good, well-run mutual fund portfolio that's no load, right, and has a low expense ratio is much more appropriate in bond land, if you will.
Yeah.
And then we think right now, I was actually having breakfast a week or so ago with one of the directors of a large pension fund, and once again, it rhymes with private client. We talked about how the S&P 500, you're right, it's outperformed, right? It's been tough as active managers to outperform that, but it is so top-heavy now and so concentrated because we've had 13 years of people pouring money into this index, and the way that index is constructed, the biggest stocks or the biggest companies become a bigger part of it, right? And so it's as top heavy as we've seen since the early 2000s, which is not a good thing. So I told this director of this pension fund, I said, it probably makes sense just buy an S&P 500 equal weight, which is every company is the exact same weight versus what we call market cap weighted or heavier weighted.
Yeah.
That might just be the recipe for just a little bit better performance the next 10 years.
And again, I'm taking time to explain a little bit is that, so Apple, Google, Tesla, these companies are worth so much that they dominate. If you end up buying, for example, the S&P, maybe 30% of your money went into 4 or 5 big tech companies who had already been pushed to the to the limit in terms of their valuation. They're just sky high, and we're most vulnerable for what's coming. And so your point is, in a case like that, you don't want to just buy an index, and even going a step further, it may make sense to have somebody who's a smart analyst to go through and in the old-fashioned way, and look at companies.
You're right, because the S&P 500, if you take those top 10 names, the valuation of those top 10 names in the S&P 500 is over 30 times earnings, right? If you strip that out and just look at the rest of the index, it's actually very reasonable 16 times earnings, right? So you really, I think you're at a point now where you sort of want to underweight or carve those out and really focus on the stuff that's more appropriately valued.
Yeah.
We also said, energy became 2% of the S&P 500 sometime last year, early last year or something. That's too low. We still have an economy that needs,
some sort of energy, whether it's fossil fuels or whatever.
Or solar or whatever it might be. But you do need energy, and we're not ready. As much as we want to bridge to, a lower carbon footprint, we're not quite there yet, right? We want to do it. We're getting there. But this is why we're seeing, gasoline prices $5-6, a gallon, is because of this exact reason.
And this is part of the reason why people don't often realize why they need financial planners is that they often think, well, I'm just going to buy an index and that's safe. But if they knew what you just said, if somebody's told them in advance, but you realize you're not really diversifying, you're putting like 40% of your money in a handful of companies, and they're all with huge, we use the word PE ratio, but huge multiples based on expectations of earning a ton of money in the future that probably will not happen. So people don't know this, and without paying a financial advisor, let's at some point I want to talk about this. Maybe we should shift the gear now and talk a little bit about the way the compensation works. People are often confused whether they should, go with somebody who tells them that they're free when in fact they're not free. They're selling you a product, and they're getting paid through the product, which I'd much rather know how somebody on the other side of the table is making money rather than, wonder how they made it and how much it was. So talk about your compensation program or
it's very simple. It's fee-based. So there's only one fee that we get paid, and it is a percentage of what we manage on your behalf. There's no financial planning fees. There's no, as I said, no commissions or any kinds of embedded fees. So as an example, if you were to come to us and have $2 million in assets that we were going to manage, that fee typically is 1%. And that's it, 1% of that. If we do a good job and the value rises, we get a pay raise, right?
Sure.
If we do a bad job and the value goes down, we get a pay cut.
But it stays to 1%.
Yeah, and then we have break points as it goes higher. So we have another break point at the next $2 million, and then thereafter, what have you. And on the institutional side, it gets a little bit more complex in terms of those sometimes are very competitive bid type processes. So it's a little different.
But so is there active management in that 1%?
Yeah, so that's a great question because. Okay, so let's confuse everybody, right? Is now
it's confusing already.
Yeah, exactly. If you pay us the 1% and then all we do is buy mutual funds for you, there's an embedded fee in those mutual funds, right? So now all of a sudden your all-in cost is much more than the 1%, right?
This is an important question for anybody giving you advice or purporting to be a financial planner.
Yeah, 100%. What we do, because we have an investment management arm, our roots are in asset management. You give us $2 million, we have a core equity style. So you own Bristol Myers or Merck or whatever it might be, Microsoft, what have you. So you have an individual equity portfolio and individual bond portfolio. So there isn't fees associated with those, right? And then you'll have some mutual funds around it or some passive funds around it for international or small.
But you're saying everything's captured, all the costs are captured in the 1%.
Yeah, that's right. And then and what we do in particular on the institutional side, because board members have fiduciary responsibility, we do it with our individual clients too, is we do a fee analysis once a year. We want to be completely transparent of this is what you pay us. And then if we are using any funds or ETFs, this is what those embedded fees are. This is your all-in fee to essentially have your assets managed.
So just for a sense of perspective, what is somebody commonly paying in fees when they think that they're paying nothing for a brokerage firm, for a mutual fund, even a no-load? They think no-load means there are no costs associated with the investment. That's impossible.
That's right.
Yeah,
that's right. So your typical advisor's probably charging somewhere around 1%. We see with the wirehouses or the brokerage firms, sometimes it's a little more than that, right? And then some are a little bit less, but just 1% is general. But then the portfolio is chock full of mutual funds that have embedded fees and what have you. So you're typically seeing probably something closer to 2% in a lot of cases. And that's too high. That's too high in our opinion. It was easy when bonds were yielding 5-6% and the stock market's doing double-digit returns, nobody really paid attention to fees. But as all those returns have compressed and what have you, it's much more important because that eats away at your retirees, their net income, if you will.
Yeah.
So you really want to be careful about the fees that you're being paid. And I think what you want to aim for is something in the $2 million range. You want to aim for something all in, something that's closer to like 1.25% or something like that, but not 2%.
And we hear all the time about cryptocurrency. What are your thoughts about investing in cryptocurrency? I'm going to ask both of you.
Well, that's a hot topic right now.
It really is.
Yeah, so our general overview from the firm perspective is that cryptocurrency is just very speculative. So we don't have any cryptocurrency in any of our clients' portfolios. If they do invest in cryptocurrency, we really try to have that only be a small portion of what they're going to invest in and have the understanding that that might be money that you completely lose.
Right.
It's a very risky asset. And that's kind of really what our thoughts are. It's more speculation than a stable portion of.
It's not a good solid investment then.
No, and Joe said it. The client's the boss, right? At the end of the day, it's their money, but we're not going to let them hang themselves. and we're going to educate them on that. And crypto is exceptionally speculative, right? And so if a client insists that they want to do something, we just say, this is like your money if you're going, to Vegas or what have you. You might have an asset that's permanently impaired. It's, it essentially goes to zero. So be very cognizant of that, if you will. And so we typically say, if you're going to do it, we're not recommending it, but you put that sort of on the side, if you will.
And that whole thing about crypto is such a fascinating discussion to me. And I feel that to some extent maybe it's a product of age, though I know some of its advocates are older than I am. But I still feel that there's a little bit of a perspective that I bring to the table which may or may not be helpful. It may be helpful, but it may not be. But the idea that you create this thing for which it seems to solve a problem for which there's not a need. And I think of the fact that you have something called Bitcoin that appears to dominate value, but it's just a declaration by its creators and an affirmation by others in the market who are willing to buy it that we're going to assign value to this. Mm-hmm. It's just like a fiat command, except by the market, but it's a fiat command that we're going to decide this. It doesn't have a history like gold, I understand, a million years of history valued by humanity and used as a medium of exchange, et cetera. So I understand why that lingers as having some value. But crypto just mystifies me, and yet there are people who are so certain that it's going to be around. And I just don't – you have the regulatory risk. Mm-hmm. No government is going to allow crypto – if people who are fans of crypto believe that by having crypto they can get around all the laws of government, that will never happen. No government will allow that to happen.
No.
So we know that it's going to be regulated in some form. And if they're saying, no, we just want digital because we think digital is more convenient, well, governments we know are going digital. Mm-hmm. I mean, it's coming whether you like it or not. And the U.S. is looking at it closely and doing studies, so we'll have a digital currency. I just don't see the need for this thing. And it's what protects it from 1,000 other similar blockchain creations.
Right. It's interesting you say that because, cryptocurrency was invented to try to actually ease transactions, right?
Yeah.
To make transactions easier and almost, as you said, a store of value, if you will, a medium of exchange, which would mean there would be some stability to it. It's the exact opposite of that. And what it's become is not that. It's become essentially a speculative investment, if you will. And I actually had a client that was trying to sell some real estate, and it was interesting. The gentleman that wanted to buy it would only do it in Bitcoin.
What?
Right? Yeah, and
that is interesting.
Yeah, it is interesting. But so the transaction took 6 months because it's not easy to and to your point, there's not regulation. There's no financial intermediary that's going to allow essentially an insured closing, right, of real estate to happen vis-a-vis a cryptocurrency. So it ended up being 10 times more difficult than just settling in, good old-fashioned dollars, if you will. So I don't see it serving the original purpose that everybody sort of purported it to be, right, if you will. Blockchain, the technology is interesting, and that's different than I think the underlying technology. That the applications of that are fascinating to me.
Oh, it's great, yeah.
But that's different than what we're talking about with cryptocurrency. I mean, your audience, they'd have to have exceptionally excess financial resources to say, I think that's something you should be speculating in, if you will.
And as we sit here today, it's around 20,000. Is that right? Is that what I last heard?
It was peaked around 60,000 for Bitcoin, and then just looked yesterday, it was down to 20,000. So
yeah, so it's taken a huge fall.
I don't know how you value it. There's no underlying cash flow. There's no income to it. But the folks that follow the market that I sort of casually listen to say you're probably looking at something around 7,000-8,000. So there's a long way to go if they're correct. Once again, it's not a market we follow real closely. But.
So I'm saying what a lot of some sages have said, and what you all have heard, and Buffett and others have said similar things. But these old guys, maybe are missing something, but they're universal almost in saying, there's no need for this. It's a fad. We've had fads before. The Holland tulips. So we've had crazy fads, and this is going to be a fad. And I don't know if Buffett's still saying that. He said that early on. And to me, I that still strikes me as seeming probable. But then I listen to some very smart guys, and you do too, on like CNBC, and they'll talk about, the fact that, look, I heard some guy yesterday on, I don't know, it was Jim Cramer's show, but he was saying, yep, whatever happens, crypto's down, but one thing's clear, crypto's here to stay. And I'm convinced that maybe I'm missing something. Maybe it'll be around and still be around in 20 years.
Yeah, maybe I'm not smart enough to understand this, but I've been doing this for 25 years now, and I've seen all these. Every bull market ends with these. There's always a couple speculative asset classes, right? And if you look back, it's going to be crypto. SPACs were another area, if you will. SPACs. So you're starting to see this bubble implode, right? And those things go down. I always say version 2.0 is always better than version 1.0, if you will. And so there could be something in 2.0 in terms of crypto that makes sense, right? Once regulation comes into play and there's some guardrails put up or what have you, that might make some sense. You remember .com 1.0, that ended in tragedy for most companies.
Yeah.
Right.
But
notoriously.
Now there's some really good, internet-based companies. .com 2.0 ended up being much more sustainable and much more profitable. So maybe there's another version, coming, if you will. I'll wait for 2.0.
So if you're, and I realize that you don't have a crystal ball, but so when you think about what is likely to happen with inflation, do you see the Fed becoming more determined? I mean, we do have this 3/4 point in 0.75 basis points going up. I mean, do you see that Powell is going to become more committed to get ahead of the inflation, or do you see continued timidity where maybe we're going to have inflation for a couple years?
Yeah.
What do you think?
I think today was a real good signal that they're getting serious about it, right? 75 basis points with, it looked like in his comments, most likely another 75 next month, right? So I think they're trying to tackle it now. Obviously, I think we all agree behind the curve, we all know what the roots of this were, which was we didn't have a playbook for a pandemic, right? And so we thought we needed to give out a lot more fiscal stimulus and monetary, stimulus, if you will. We did too much. That was the root of it. And then you get supply chain bottlenecks and people spending money, right? And that's where we're at today. We do think you have to feed inflation, and we're not feeding it anymore. We're in a QT world. We're in a rising rate world. So we do think I don't know if we're at peak or we're close to peak, but we think it's going to start to come down. I think the best case scenario is you get 5% by the end of the year and 4% sometime next year. We're not going back to 1.5 or 2% anytime soon. I know that's what they target is 2, but those days where, we were worried about deflation, we're not going to see that for some time. So.
Yeah. So you would, though, expect the inflation to cool down by the end of next year.
Yeah. Yep, that's our forecast right now. Just given the fact that we've just, all the stimulus programs have expired for the most part. There's some things still out there like the student debt and stuff like that.
Right.
But and then most of the inflation, I think, from our perspective, the bottlenecks will change as the pandemic eases and China comes back on. The administration's looking at potentially some changes to the tariffs. I think the tariff stuff ahead of the pandemic fed into some of the supply chain issues, if you will. And I think they're starting to rethink maybe some of that as well. So we'll see. But yeah.
Yeah. These macro trends you wonder about over the next 5 to 10 years, and among them is, as you mentioned, is what is the course of globalization, and it looks like we globalized the first 20 years, and now some say we're going to deglobalize, we're going to disengage, and that means more costs and less efficiencies, and some would say that there's kind of a built-in inflation. There's an interesting argument by a couple of academics who had written a book called The Great Demographic Upheaval, I think was the name of it. Anyway, it's a book in which, and it's much talked about, and one guy's from London School of Economics, and he says that population trends coupled with the deglobalization, which he thinks is not going to stop, he thinks it's going to continue for various reasons, And he points to changes in workforce into the aging sector that all these things together are going to require that prices go up, and that there will be. He's not talking about runaway inflation, but he's just saying that we've seen deflation for the last 20 years, and that and he explained those forces were very predictable. We had the wall coming down and the whole Western Europe becoming available as a market. So all these wonderful things, China was coming on board. He said that has played itself out. And now, we've peaked on those favorable trends. And now we're going to see the other side of those trends. And I guess if you're looking at something like that, you can take the model of your firm, your software. So if you had a client who comes in and says, I believe that argument. I think there's probably going to be inflation on average the next 10 years of 5-6%, say 6%. You can plug a number in and you just adjust the plan based on your client's particular expectation.
Yeah, yes, we do. We actually have some additional software that's sort of interesting called Hidden Levers, but we can sort of model an economic regime like that, almost like a stagflation kind of regime, like a 70s, style, and show clients what might, occur with their portfolio given that kind of period of time, if you will. So that's one element we can do, and then we can also plug in, like you said, 6% inflation. That's not our 10-year forecast, but let's say we did that. What that means to a retired client might be a little different. I'm spending a lot of time with clients saying, the CPIU might not be your inflation, right? Everybody, because early in retirement, you travel, you go out to eat, you're active, and those are higher components of your inflation. And then as you get older, medical care becomes a bigger part of it, right? And you slow down on a lot of those things. And we have a lot of real life examples where we see the expenses come down quite a bit later in retirement, right? Outside of the medical side of it. So you sort of have to, and what we spend a lot of time with is telling our clients, okay, what does that living expense look like year to year? Are you seeing it really go up, or are you not seeing it go up? You drive less, right? So your used car prices don't affect you as much, right? If you're not driving as much,
not spending as much on gas.
Yeah, so that's why that revisit the plan, and I keep saying that, but that's really important because I had a conversation just this week with a gentleman who retired a couple years ago, and things look good, but he's nervous, as everybody is, and I said, let's go back. Are you spending more? He goes, no. I said, are you starving? He goes, no. I mean, everything's good. I'm like, then maybe your inflation isn't the same as somebody else's inflation. I own a home. I have a fixed mortgage, right? So the costs of that are not going up, right? It's a fixed mortgage, and I'm not renewing a lease every year, so I'm not feeling the rent, the rent's going up. Now, having somebody come and work on something, or going to, Home Depot and buying something, that those things are going up. But so I would say it's a little different. You got to sort of look at inflation in terms of your terms, if you will. And we've done that on the institutional side as well. Educational organizations for a long time have had what's called the HEPI, which is the Higher Education Price Index. They don't follow the CPIU.
I've never heard of that.
Yeah. So, and it's really interesting because, and for years, you would have essentially, tuition costs going up 5, 6, 7%. And that was during the period of time where inflation was 1.5%. So education expenses were really high, medical expenses were high, but man, you could find cheap goods anywhere, right? So that has sort of shifted a little bit. But we look at, in a lot of times in spending policies and planning, we look at your inflation, right? Or the organization's inflation, which should be a lot different. A lot of organizations are struggling right now because salaries and wages are going up.
Yeah.
And that's tough, right? And meanwhile, not-for-profits, they're doing really good work in the community, which with maybe, their base is folks that are sort of food insecure, right? Or paycheck insecure. They're going to be coming and needing more help. Because, gas prices at $5 and, the cost of these
trickle-down
things.
effect.
Yeah. It affects that group, that cohort a lot quicker than it does, folks that are at the higher socioeconomic, part of the thing. So,
you're right. If you can take out, if you can be in a position where the energy costs are not going to impact you, at least directly, too much.
Yep.
People are buying cheaper cars. They say you can get a car. It's crazy. I mean, who would have thought you could make money selling a used car for more than the new ones we're selling for? But
yeah.
So, but if someone, for example, would extend their miles per gallon by 2 to 3 times, then that's going to more than offset the additional costs of gasoline right now, which now was over $5
Yeah, it is. And the car I have, they want you to put 92, 93 in there, right? And so I'm putting 87. I go to AutoZone and I buy a little fuel treatment for $4.
Yeah.
And it's saving me some money. And my dad was very proud of me. You know, he's an engineer. He thinks that way.
Yeah.
My kids were laughing at me, but that's the kind of thing you have to sort of get creative with, right?
Well,
yeah.
And the other element of the CPI, which the core excludes energy and food. So food you can't, you're going to get tagged with food. But after those two, the next largest component, and it's of course the housing costs. And as you point out, people who are in a house, they've paid for most of it, which many of our people have, then that definitely is something that wouldn't affect them as much. But I read that 42% of the CPI of the increase is attributable to the 3 factors of food, housing, and energy.
Yep.
So if you can manipulate those in some way, food's the least. But you can, some people are not going out as much.
If you're counting on travel, if you're retired 3 years ago, right, and you're counting on to travel a lot early in retirement, it's pretty frustrating because you had a pandemic, you couldn't travel, right? And now I've been checking flight prices just to the East Coast, and it's unbelievable. To fly a family of 4 it's unreal, right? So you feel bad for those folks who have been sort of working their whole lives and want to travel. So that's the one area I would say is a little is tough on folks, right? Is that airfare kind of thing, travel costs. So
one thing that I want to get just a quick sense of Goelzer before we leave, is what is the ownership arrangement of the firm?
Yeah,
it's based in, of course, Indianapolis. But go ahead.
Yeah, no. So we're 100% independent. So we're not affiliated with banks, insurance companies, or private equity.
Okay.
We're actually an ESOP. And it's pretty rare.
Oh, really?
Yeah, pretty rare in the RIA world. But the employees own a good chunk of Goelzer, right? And we think that's the ultimate inclusion, if you will, is for everybody to have some ownership. So if you work at Goelzer for a year, you're a participant in the ESOP. So we really, really think that's a real differentiator for us, and everybody thinks more like an owner then.
Yeah.
Yeah, that is interesting. How long has it been in ESOP?
So back in the early 2000s, and don't quote me on this, but Don Goelzer at the time, who since passed, was really wanted. I mean, the reason he started Goelzer was the firm he was with in 1969. He asked for some ownership, and they said no. And so he walked across the street, opened up Goelzer. That's the story. And he wanted to develop that and also get some liquidity, obviously, as a succession plan. So it was opened up in the early 2000s.
And that was about when he retired, or did he hang around?
No, he hung around. I've been there 15 years. I got to work with Don. He was sort of part-time at that point for a couple years, but so he's been gone. Greg Goelzer, his son, is the CEO, and he took over for Don when he retired.
I see.
Yeah.
So that's an interesting model. I think it's good for client service too.
Yeah, I think it is. I think the independence, it's really hard right now for a lot of firms to orchestrate a succession plan, and I think we've done a really good job that way, and we're hiring Brett, great people like Brett, as the next, sort of the next generation. So we're really excited about that.
And you'll be going to other cities after St. Louis, you expect?
Yeah, we're 53 years, we're in our first city, so we don't move real fast.
We shouldn't hold our breath.
Yeah, that's right.
Another 53 years.
Yeah, but yes, I think that is the goal, is to continue to expand, but we do things very methodically and carefully.
So you're not set on a national plan. In other words, this isn't the first step of a multi.
No, and if I would have answered, hey, private equity owns us, they would push for something like that, right?
Yeah, they would.
Yeah, big aggregation. That's not our goal. So.
Well, we're glad you decided to expand in the Gateway City.
So where will you be officing?
Yeah, so right now I'm working remotely,
Okay.
and so I'll meet with most clients at their place of business for the most part until I guess if we grow, we might eventually have a brick and mortar here. So that's kind of the plan going forward.
We're looking forward to Brett getting his first client, and then we'll
Then-
be looking for lease
Then you'll
office
talk
space.
about office, right? In that order.
That's right.
Well, there's perks to working from home.
Yeah, and I can just tell you that, and this is kind of off the point. We're wrapping up here. Just to comment on the whole remote working thing. I mean, we're dealing with it as a law firm. Our attorneys expect it now. So I had a lunch meeting with the partners, and we talk about, how do we keep clients as happy. But I really think that while there may not be a snap back to what there was before, I think that we're going to come a good distance back. And I know people who own office buildings will be glad to hear that. But it's in very small ways. I mean, think about whenever you've talked to professionals, if you've talked to a lawyer lately or you've talked to anybody. I was talking to an architect yesterday. And so I'm on the phone. We're having a Zoom meeting. Now, we had to have a Zoom meeting because he's in Asheville. So we're having this, or he's in Asheville? Hilton Head. So we're having this meeting. And so there's something that we wanted to look at a previous floor plan for this, laying out this renovation. And he says, and you can see he's at home, dog and kids. He says, I don't have that. I can't do that now. He says, I'm not in the office. And, that kind of, as a customer, I mean, it's not as if his prices went down. And I think that consumers are going to demand that that all of us as professionals go back. And it's going to be hard for lawyers. I can tell you, our lawyers right now, it's going to be very difficult for us to get them to come back into the office the way they used to. So I don't know. We may end up someplace in between. This has nothing to do with you. I'm just this thought is on my mind.
I think you're right. I mean, I gave up a tie a couple of years ago, which I thought I never would, and now it's remote work, and so things are changing
Now,
from when I started.
That may not come back.
Yeah, I don't think so.
I don't think that will for a long time. Given the younger generation today,
Yeah, they're casual.
they're casual.
Much more.
Yeah.
But you're right. You can do so many things remotely, and you can do it effectively when you plan it. So, but you'll be living here.
Correct. Yes. Yeah. So my previous firm, I had worked remotely for the last 5 years as well, prior to the pandemic.
Before it was cool.
Before
a lot of people
before it was
did it.
fashionable, yeah.
So I have kind of a whole office built out. Clients were nationwide, so about 50% of the time we were visiting clients. So Zoom has benefits because you have maybe 10 people on a board. Logistically is easier to meet that way. But as as Don mentioned, relationships, I think it's very important to still meet in person.
A cup of coffee and
Right.
yeah.
that we'll still be very focused on that. And a lot of our institutional clients expect that. I think at least
Sometimes.
at least once a year at the minimum.
I'd rather take, too. I mean, I think we could spend money today on a leasing space, right? I'd rather take those dollars and get it in the St. Louis community, right? And then once we built up enough, sort of enough core, then it makes more sense. But we're so about getting in the community, engaging. We'd much rather do that, if you will.
And if you're set up for at home, like the example I just gave, this could have been done effectively this way because it was going to be by Zoom anyway.
Mm-hmm. Yeah.
But it was that, he normally had an office and he kept a lot of his stuff in that office. And then when he decides to be at home, he's handicapped in terms of his ability to get things done. If you set up as you've done, doing this 5 years, I mean, you're set up to provide the same level of service that you would otherwise.
Yeah, correct. So it's a completely separate space in the house, completely set up. I have all my technology and everything in there. So it's just, I treat it just like a regular workday. Get up and go in and do what I have to do. Zoom has made it a lot more easy. I think we've all been doing too many Zooms over the last couple of years.
Oh, yeah.
Zooms and Teams and
But I have to
WebEx.
admit, I get far more done with Zoom than I thought I could have. I mean, if you told me a year ago that it could take me as far as it has, I wouldn't have thought so. But 2 years ago.
It saves a lot of travel time too,
It
right?
does.
I mean, between obviously being busy, it makes it tough. So I have found it. I do like 3D interaction. So I like the 50-50 sort of mix, if you will. You get some efficiency, but we had acquired a client literally May of 2020, so it was during the pandemic, and then all our subsequent meetings were Zoom, and we finally got to meet him. They finally did a live fundraiser last summer. Oh, you're real.
There's a three-dimensional.
That's right.
Well, it's a pleasure, and we like to be able to turn our audience on to people that we think can meet their needs and have an investment philosophy that's consistent with people who are over 60, which is a little different from somebody who's 30.
Yep.
Mm-hmm.
Yeah, for sure.
Or it should be.
Yeah, definitely.
No question.
But anyway, so it's Brett. We'll go ahead and put your contact information on the website, so if anybody wants to follow up. But Goelzer is the firm.
Yep, Goelzer. Yep.
And they're going to hear a lot about this investment.
It's been a pleasure having both of you gentlemen.
Thank you very much. We really appreciate it.
This has been another episode of Life's Third Act. Till next time, take care.
You've been listening to Life's Third Act, a podcast for thriving in retirement. Sponsored by Tucker Allen, your estate and elder law advisors. Each week we discuss topics and answer questions to help you better plan for your future. For more information, visit tuckerallen.com. Subscribe and listen again next week for another edition of Life's Third Act. The choice of a lawyer is an important decision and should not be based solely on advertisements.